Happy Independence Day traders, Robert H. here. I hope everyone's having a great 4th of July. So today we're going to go over an infographic that one of our members helped put together, Robbie Williams. If you recall from a few weeks back, we talked about a day trading plan, the importance of having one when you're running a day trading business, right? Knowing your numbers, what's the risk management, what's the money management, what are the rules, what are the strategies, patterns, etc. So this infographic that we've put together, it is basically all the numbers that you need to know, represented in charts, graphs, and pictures, right? So you can easily digest, understand these things a little bit better. Let's dive right in. Share sizing table, right? Stop loss and risk management. What are the connections between all these things? Well, take a look at the little reminder down here. Maximum number of shares allowed is based on stop distance and dollar risk. You should never risk more than 1% of your account on any one trade. Less is okay, but never more. Now, I come from the school of thought that you should risk the same amount on every single trade, what I call an R, or a risk unit or risk multiple. You can Google that. It's something Van Tharp discusses, VANTHARP. Basically, I believe that if you risk the same amount in every single trade, that will allow the probabilities to work themselves out better, right? Because if you're risking half size on one trade, full size on another, whatever the case, 2 times on another, you don't know which one's going to be a winner or loser, right? So how is the math going to check out in the long run if the dollar risk is different across the board, right? So I'm saying 1%, you can do less, you can do 0.5%, 0.75%, but never more than 1%. All right, enough rambling about that. Let's take a look at this table. So this table shows stop loss, which is the distance between your entry and your stop. Remember, your stop is a technical level on the chart, right? Whether it's VWAP, whether it's some prior candle that you're using, right? Prior candle, maybe it's a pivot or whatever the case, right? It's got to be a technical level, not some magic number you pulled out of thin air or what you feel like risking for that day. And then you have your dollar risk per trade. When you're first starting out, you want to be risking very small amounts, 10 bucks, 20 bucks, whatever the case, and you want to increase size as you get more consistent, right? Until you get to this 1% threshold, never more than that, right? And so if you're risking, say, $100 per trade, and your stop is telling you you need to give it 40 cents, then you're going to take 250 shares, right? So look that up. Look up the cross section. If you're risking $500 per trade and your stop is $1 away, say it's a spready, volatile stock, you need to take 500 shares. That's how to use that table. Very handy. A lot of traders actually keep this printed on their desk there. Or if you're like me, you have a hotkey that will just automatically calculate your share size based on your stop. Next, let's talk about risk management. The higher the reward, the lower your accuracy needs to be to break even. Right, that's a pretty basic concept. Break-even accuracy is based on the reward to risk ratio, what you realize at the end of the trade or the end of your trades. So if your reward to risk is 5 to 1, right, your winners are 5 times bigger than your losers, you will break even with a 17% accuracy. That's pretty extreme, right? 5 to 1, 4 to 1. These are all extremities. Most traders will fall in this realm here, right? 1.5, 2 to 1 area. So you need to know these numbers. What's your break-even rate? Well, 2 to 1, it's 33%. With 1.5 to 1, it's 40%. And this, you're going off the other end, right? This is where your losers are, say, for example, 3 times bigger than your winners. This, you need to be 75% accurate to break even. That sounds pretty outlandish, but I actually know a lot of traders struggle where their losers are bigger than their winners because they're not letting their winners run. It's like 1.5 to 1. The other way, right? Their losers are 1.5 times bigger than the winners. And they have a pretty high accuracy. Not going to lie to you, 60, 65%. But that means nothing. That's break even, right? When your winners are smaller than your losers. That's just a quick reference table for that. Next, we'll talk about the heat map. So profitability is a function of payoff ratio and accuracy. Payoff ratio is calculated as follows. Your average winner divided by your average loser. Let's make an example here. So say you took 3 trades, winner, loser, winner. The first winner, you got $150. The second trade was a loser, you lost $100. And then your third trade was a winner, you made $200. So what's your average winner? Well, 150 plus 200 is 350. That's 2 trades, so that's 175, right? And then your loser is 100, so over 100. Your payoff ratio is 1.75. Payoff ratio is also synonymous with reward to risk or realized reward to risk, right? So 1.75. Now let's take a look at this table, this heat map. Basically, if you are trading, day trading, you probably fall in this realm. You're never more than 75% accurate, and your payoff ratio realized is probably not more than 3 to 1. Rare cases, there's people out there going 4 to 1, 5 to 1, but I think most traders will fall in here. Now let's assume you take 100 trades. You know, most people can accomplish that in a month. Personally, I take around 50 to 75 trades a month. And based on your win rate and payoff ratio, this is going to be your percent return after 100 trades, assuming you risk a fixed 1% of your account per trade, right? So this is the numbers I'm always talking about. So I'm trying to get 2 to 1, and with a 50% accuracy, I should return 50% of my account after 100 trades. Now, if you're aiming for less than that, say you're only looking for, I don't know, 1.5 or 1.4 to 1, you're probably going to achieve the same results with a 60% accuracy, right? 44%. Or if you're doing higher, say you're going 2.75 to 1, you can achieve that with 40% accuracy. So you will fall somewhere here, right? The key is to find, based on your trading style, what makes more sense, to hold longer or to get higher accuracy. Because if you're going to hold longer, you're going to deal with a lot of BS stuff, right? Things will come back to your break even, yada yada yada, won't hit your target. But if you're in and out really quick, then you're going to have a higher accuracy to achieve that. If you're a 1-to-1 trader, to match that 45-50% area, you need to be 75% accurate. You need to be right 3 out of 4 times. That's really difficult to do, right? So, figure out where you want to be in this chart, right? After 100 trades, obviously you want to be in the green area. You don't want to be in this loss area here. And as I was saying in the previous chart there's people who are 1-to-1s or less than 1-to-1s, and they have pretty decent accuracy rates, right? 60%. But the fact that their losers are coming out bigger than their winners because they're scaling out too quick or whatever the case, or maybe they're averaging down, not stopping out, whatever the case, they're going to be stuck in this this red zone, which is where you don't want to be in the long run, right? So this is thinking in probabilities, guys, right? Over 100 trades long term, the system will work itself out, right? Notice that with larger winners, the accuracy required to grow an account becomes less, right? If you're going for 2.5, 3 to 1s, you can be less than 50% accurate. You can be in this realm here, right? 40, 45% accurate and still make money. But as beginner traders, you should seek to return 10 to 20% per month. That's 0.5% to 1% per day, right? And 100 trades. That's a nice, easy number to work off of. But 20% a month is, you don't have to be too accurate to achieve that, right? It's like in this kind of this realm area here, right? 60% with a 1-to-1, 2-to-1 with a 40% win rate. This is obviously before commissions and fees, but it doesn't take that high of an accuracy, guys, to return 20% a month. It's actually quite attainable if you stick to the system, stick to the rules. Okay, so now let's talk about growth. People always talk about growing a small account, right? And if you go out there on YouTube, you'll see some pretty unrealistic claims. Obviously, these people have more experience than the average beginner trader, but they can grow an account. The small account challenge, they can grow a $1,000 account, $500 account, whatever, to 5-6 figures, right? Which is very difficult to do. As a beginner, though, if you're aiming for the numbers that I just spat out earlier, 5, 10, 20, 25%, you can actually grow an account pretty quickly, right? So in this chart here, projected monthly compounded growth based on various rates of return per month. Starting with $10,000, if you return 5% per month. After a year, you should almost double your account, right? If you're doing 10% per month, right, that's 0.5% daily, right, on average. You will double after roughly 7 months at this point here, right? So the rule of 72, you take the percentage and you divide it by 72. That's roughly your doubling time. So for 20%, right, 20% over 72, that's roughly 3.5 months, right, 3.5 periods. As you can see, that's happening roughly here. That's where you're doubling. Right, so it doesn't take very long to double an account. The key is not blowing up and not trying to aim for get rich quick scheme, all this stuff. It takes time, right? But compound growth is very powerful. We'll discuss that very shortly here. Right, so this chart shows how many months it would take to double, basically what I talked about earlier for every percentage there that shows a doubling time. So 5% is roughly 14 months, 10% is roughly 7 months, 20% is roughly 3.5, 4 months or so, right? And Albert Einstein put it best, guys. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And we'll see that. So we just saw that you can grow an account very quickly with compound interest as long as you're reinvesting your growth and not pulling money to your account. And he who doesn't pays it. We'll see that later down here. Capital preservation, right? If there's one rule, it's all about protecting your account. Day trading is all about capital preservation. Above all else, we live to trade another day, right? Protect your account at all times. So assume a $10,000 account has multiple losing trades in a row. This can happen, right? You can have 5, 6 losers in a row, up to 10 losers, who knows, right? Think about it like flipping a coin. If you're a 50-50 trader, the odds of you flipping a coin 10 times and getting heads 10 times in a row, I don't know what the exact number is, but it's not impossible. It can happen, right? It's probably some 0.0000 whatever percent, but it can happen. 4 or 5 losers in a row can obviously happen, right? Even with depending on the market conditions. But if there's any key to surviving, right? This is what Dr. Brett talked about in one of the podcasts that I found online. There was number one is how can you survive a drawdown, right? Everyone will have drawdowns. The pros will pack it up after, some, maybe they won't trade that day if it's garbage, or they'll pack it up after 1, 2 losers, 3 losers, whatever the case. Right? Anyone can catch a winning trade. Catching winning trades is not difficult to do, right? It's not rocket science. It's the red days is what separates the pros from the amateurs. The pros will stop. The amateurs will usually give it all back, right? They can't accept that fact and keep losing, or whatever the case, right? Have a Hulk day, the boom and bust cycle, what I keep talking about, right? So this table down here will show you, based on what you're risking per trade, how severe can the drawdown get after X number of losers in a row. So let's take the 1% example. If you're risking 1% of your account, you lose one trade, that's 9,900. Your account goes from 10,000 down to 9,900. Second one, you lose 99 bucks, 98.01, etc., all the way to the end. After 10 losing trades, you're down about 9.6%, right? That's not too bad. But look what happens if you're risking 5% per trade. That sounds like a lot, but there's people out there doing it. $5,000 accounts. They're out there with the big leverage, 6-to-1, 8-to-1, whatever the case, and they're risking $250 a trade, right? Maybe they don't know that, but they don't have risk management rules in place, etc. They're coming out with $500 losers. Who knows what the case is, right? Trading low floats, etc. After 10 losers in a row, you can be down 40%. That's a big drawdown, right? If you're risking 10% per trade, you could be down 65% after 10 losers in a row. So how do we represent that better, right? As you can, obviously, it's pretty clear that the more you risk, the more you're going to be down after the end of this losing stretch, all the way down to the extreme here, 90%. Let's take a look at what it takes to come back from such a drawdown, right? Based on the losing trades above, the chart below shows the gain required to return to break even. And I believe this is how most accounts are blown up. People don't go to zero intraday or over their trading career, right? Their account doesn't go from 10K to zero. It usually goes from 10K and just bleeds. Maybe they get down to 2K, so they're down 80%. Then they realize, holy smokes, I'm down 80%. I need to grow my account by 400% to come back. And they'll just pack it up and quit, right? You get to a point of no return. As you can see, the more you risk up there in that losing stretch, the more you need, the amount you need to recover is exponentially more, right? Here it's manageable. You're down 1%, you're down, after 10 losers, you're down 9.6. You only need 10.6 to come back. That's achievable. But look what happens in this realm here. You're down 40%, you need 67% to come back. You're down 80%, you need 410% to come back. You're down 90%, you need to grow your account by 831% to come back to break even. And that's represented here by this bomb, right? You've just blown up your account. So it's going to be very difficult. You're going to have to top it up or do something else, right? Okay, enough about that. That's depressing. Let's talk about outcomes, right? So if you believe in probabilities and you're managing your risk with stop losses, either mental or hard, but you always respect your stop, there should only be 4 outcomes for any given trade, right? This is what it boils down to. A small loss, all losses will be small relative to your account, maximum 1%. You can stop it before then, whatever the case, but never more than 1%. Break even, if you decide to get out at break even, if you want to get back in or you just don't like the price action, that's another outcome, right? The third outcome is a small win. Maybe you took a partial, came back on you, whatever the case, or you got out before a dump and you managed to get a little bit of gains. That's one outcome. And then the big win, right? 1.5 to 1, 2 to 1, 3 to 1, whatever the case. And there's people in our community out here, getting 2.5, 3 to 1 realized per trade. They're very patient with their exits, which we'll discuss at the end of the infographic. But these are the 4 outcomes. So if we took a scatter plot of all of our trades, right? We just plotted them. What was the payout ratio realized? This is the break-even line, right? This is where you broke even. And this is 1 to 1, 2 to 1, 3 to 1, etc. This is minus 1 to 1. So let's take a look. All your losers would fall here, right? Below the break-even line. All these losers, small losses. And your small winners would be in this area here, right? These small winners should cancel out your losers, right? 1 to 1, minus 1 to 1. This is what I call business as usual. Small wins, small losses, break even. These cancel each other out. It's mundane, nothing exciting to talk about. This is where the majority of trading happens, right? But the winners, right? The 2 to 1s and greater. This is where the money is made, guys, right? As these cancel each other out, all of this is the profit zone. This goes into your pocket, right? This is where the money is made. They're more rare, but they grow. This is what grows your account at the end of the day. This is how your trade should look. If you haven't done this, do a scatter plot and see, is it really, do you have trades down here, like losing more than 1 to 1? Because there should be no such thing, right? If there is no such thing as big losers when you manage risk correctly, you should never have anything down here, right? It's non-existent. So if that's the case, then these there's no counterparty. These are all profits, right? Because these guys have canceled each other out. All right, so that's outcomes. Let's talk about scaling out finally. Number of shares remaining after taking partial. So people scale out differently. Personally, I don't scale out. I'm doing all or nothing. But if you are scaling out, you can scale out with using your hotkeys, right? So some people use 10% of remaining, 25% of remaining, 33%, 50% of remaining. This shows how many shares you have left after the first partial, right? 1 strike of the hotkey, 2 strikes, 3, 4, 5. And why do you need to know this? Well, you need to know this because if you're scaling out very aggressively, you're not going to have many shares left, right? Often I'll see people after a 1-to-1 move, they may have pressed the button 4 times. You take a look, depending on what they're scaling out with, they have very few shares left, right? After 4 hits of the key, if you're scaling out with either 25, 33, or 50, you're going to end up with a third, a fifth, or 6% of your shares left. Right? After the 3rd or 4th or 5th tap, there's not much left, guys. And this is something you need to keep in mind, because how are you going to let your losers run? If you're not patient with your exits, you will run out of shares. I used to get in this scenario. By the time I hit 2 to 1, I'd have like 5% of my position left because I was scaling out way too fast. So be cognizant of that. All right, so that's the entire infographic, this big giant poster. Again, we're going to release this on social media, 1 infographic per day. Please subscribe, please follow us, and at the very end we'll send this out and you guys can keep it, print it out, keep it on your desk or whatever the case. Maybe you can frame it, who knows, maybe we'll put together a competition, see who can put this at their day trading station the best, either on the wall or whatever the case. All right, so thanks for watching. Again, happy 4th of July everyone. We'll see you guys in the chat room.